Right, good morning, everyone, as we head into European trade on Tuesday, the 18th of July. We're just looking at the headlines. We'll see what is going on as Asian shares slip as China casts a pall and dollar slide debates. But Asian stocks fell on Tuesday as this week's soft Chinese economic data and an absence of stimulus weighed on sentiment. Now, this was an hour or two ago. They have released some measures earlier on to help with kind of household consumption, things that people consume within their household after their the increased measures to help with the property market. So the Chinese central bank and the Chinese government are trying to lend support to a faltering economy since their opening or reopening from their COVID-19 lockdown. Economic data, you still want that to turn around and start to improve before getting any sort of before getting kind of confident that is actually taking place. So we need to see a little bit more from China, but Chinese stocks, Asian stocks, have given us a bit of a negative handover into today's European Open. Apart from that, we had the minutes out this morning from Australia, and they pretty much stuck to the script. No surprises in terms of that. They did suggest the policy was at a restrictive stance and is going to drive a contraction in or a decrease in household finances, which will lead to an economic slowdown and also potentially some rising unemployment. But they did also open the door to further tightening if needed in order to tame inflation, which is one dovish, one hawkish, and it's kind of nil-nil really on that one. Apart from that, a couple of other things, maybe something to note. Our market's still reading from China's raft of unimpressive data. Worries over stuttering post-COVID-19 recovery in the world's second biggest economy are likely to linger as Europe wakes up. Now, Europe's kind of markets or Europe's companies are heavily exposed to China. They are a large trading partner with China. So the longer the longer China continues to falter, the kind of more negative it is for European stocks. So it's maybe something to keep an eye on going forward, but not exactly much downside in terms of the DAX over the course of today and yesterday. But we'll have a look at some charts when we get around to it. Apart from that, there's not really a great deal worth of information out as we come into the rest of the week of trading. We'll come into the grid over here. We can see a bit of negativity across stocks, but the US stock index is okay. They're all red, but the largest amount any of them is down is minus 0.13%. So they're largely flat. European equities are largely flat. Asia Pacific equities, apart from the Hang Seng, which is down 2%, others are pretty flat. You can see commodities, oil down slightly, gold up slightly, copper up slightly, but again, just tiny percentages. So lack of clear direction again over the course of this morning's Asian session, kind of going in line with yesterday's lack of volatility, which maybe is to be expected on a week of light economic data. Apart from that, bond yields are down, likely to do with the Chinese recovery story. Growth in China struggling, bond yields can move lower off the back of negativity surrounding global growth. So yields down slightly again in line with yesterday. The US dollar broadly down kind of across the board, but really none of them are down by too much of percentages. You can see Australian dollar pretty mixed, Kiwi dollar lower, Canadian dollar kind of lower, Euro mixed, Sterling mixed, Japanese yen and Swiss franc are higher, but they're flat against each other. Really, they are not up by much large percentages either. So lack of direction across FX, lack of direction across stocks, commodities. Really not a great deal to see in markets over the course of today, and then that is in line with the calendar. Again, a light economic calendar. We do have some CPI print out of Canada later on this afternoon at 1:30, which will be of note today as we get around to it, as well as retail sales out from the US. Now, a weak retail sales figure, will mean continued hopes that the Fed will not hike interest rates and continue hiking interest rates. Not at their next meeting, that's kind of a foregone conclusion, but after that, into September, into November, at their next two meetings, that is then a weak data there makes it less of a chance that they will hike interest rates. So markets betting that the Fed are one and done, while other central banks around the world seemingly want to continue hiking, the Bank of England being one of them, which we will touch on in a later video. Now, Canadian CPI, the Canadian Central Bank or the Bank of Canada did suggest that they were at the end of the hiking cycle. They were not going to continue hiking rates. If this is an upward print and beats consensus, and inflation continues to remain sticky within the Canadian economy, that gives the central bank something to think about. So a bit of a pop higher on consensus, likely to cause the central bank maybe to rethink, depending on how much they do beat consensus by. Maybe this core CPI print gets above this 3.7 figure. It's kind of a long shot, but that should cause some movement in markets. And this misses on consensus, it just reaffirms the Bank of Canada's stance, and you probably should see a fresh wave of selling across the Canadian dollar. So data out Canada 130, definitely something to note in terms of the price of the Canadian dollar. Apart from that, you got a few medium impact data releases when it comes to the US, and they're probably worth keeping an eye on, especially if they come in weak and start missing consensus. Well, that should cause a fresh wave of selling on the dollar, give the dollar another reason to sell off, maybe potential for a bit of a pop higher again on stocks. But you can see across here, you look at the US dollar across the board. Obviously we're looking at a bit of downside to start the day yesterday. We kind of chopped sideways across the Aussie, across the Kiwi, across sterling. Dollar Swiss kind of chopped sideways, although it is making an attempt lower now. Dollar yen tried to pop higher through that inverse head and shoulders yesterday, had failed completely, and now it's heading back towards the low. So the rally being sold on dollar yen in line with the trend, which is not entirely unsurprising. But one thing to keep note of, euro dollar pops to fresh highs again above these highs of 112.50, back up here 112.47, 112.48. So that's making another attempt at the highs, and that trend looks set to continue. Certainly over the last kind of 5 or 10 minutes, you have had a pop higher through those highs, and that signals again further trend continuation in line with the trend that we have seen in recent months, and that continues. The dollar continues lower, euro continues to pop higher. Probably more of a dollar move than a euro at the moment, but the European Central Bank are likely to continue hiking interest rates, which then is a contributing factor to this popping higher. The Fed not looking at not raising interest rates, and that is a bit of monetary policy divergence, and that goes in line with the prior trend. The same situation is of note in the UK as well, but traders are at their highest long exposure post Brexit in terms of US dollars versus the British pound. Now, in terms of the British pound versus the US dollar, so markets are heavily net long the sterling at the moment. So in terms of does that have much further to run, I'd probably favour selling rallies on sterling now going forward. I mean, when you think about it, that's continuing to push higher off the back of bets for rate hikes to continue ramping up, and with slow growth in the UK and inflation being stubborn, that is a situation that is not positive for sterling. So the longer that keeps popping higher and the more people to get long, surely the faster of a move lower you get. So that will be certainly something to note, especially if that CPI print tomorrow comes in hot. I would suggest probably selling rallies on sterling, just judging off the immediate circumstances. Another failure to break through the highs, or a failure to break through the highs in the S&P yesterday, on the Dow, the Nasdaq as well. The Russell made an attempt through the highs but never managed to close above recent highs back here. So again, they've made another attempt, but clearly struggling at the moment to continue pushing higher. Lack of economic data plus earnings season coming around, maybe a situation where stocks don't really want to commit themselves higher above these levels. The DAX slightly lower on the open this morning, continuing lower in line with that sentiment from the last couple of days with what we were talking about in China. If investors start to get on board with that, that is maybe a situation where the DAX continues lower, but nothing of note now. In order to kind of trigger fresh downside, we'll need to see a break below that kind of 16,000 round number, which has these few lows back here. So that will be a level in focus for the DAX. Any break below that should probably open up and move down towards kind of 15,700 down here, as you can see. So we'll keep an eye on that level over the course of the day in relation to the DAX. The FTSE sideways, Nikkei sideways, not really much information we can take from them. US yields attempting to push lower over the course of back end of yesterday and into today. These lows will be significant on the 10-year yield, so keep an eye on them. 2-year yield, a little bit off them, so won't worry about them too much just yet, but that should be it's likely to be a negative growth move, plus US stopping hiking interest rates. So the longer that continues lower, the more that continues lower, probably likely to see some fresh US dollar downside. And the longer these come down lower, the more positive that is for gold. Now we are approaching, we had this inverse head and shoulders that we broke out of we alluded to last week, we've popped through this trend line, and now we are up testing this near-term resistance level. A break up above here should probably see us test one kind of 1985 up at these kind of highs around here. So we'll keep an eye on this resistance level over the coming trading sessions ahead in relation to the price of gold. Apart from that, that's really where we are at in terms of markets. Oil has had a bit of downside, which not too much after the extended run, as not to be unexpected in the price of oil. But apart from that, nothing really out of note later on, apart from what we have already just spoken about at 130. But US dollars seem under pressure. That 10-year yield is something to keep an eye on. Euro dollar pops higher. Stocks failing at the highs, but earnings reports make it maybe a little bit difficult to trade. And gold approaching those highs up there. So I think US yields the one to keep an eye on today for some fresh direction into the European and into the US session later on.